It's never a good thing when the front page of the Wall Street Journal has a story about CEOs flexing because they're firing people and replacing them with AI and offshoring to a greater extent. If you incorporate the Cleveland Fed new tenant rent index into the market-based core PCE, which he instructed us to do last December at the podium, then inflation year over year is running at negative 0.3%.
Negative. Wow. Okay, so policy error then?
Absolutely. Policy error.
It's Fed Day. We're joined once more by Danielle DiMartino Booth, CEO of QI Research. We'll be examining the latest FOMC decision, some of the questions asked during the press conference, as well as looking over the recent economic data releases from this week. So GDP came out today. Yesterday was consumer confidence. And this week also was jobs data. Welcome back to the show. Danielle, good to see you.
It's great to see you. Thank you for having me.
Thank you for being here. Look at what Powell said in his opening statement.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Okay. Importantly, he mentioned later that there is now a rising risk of unemployment and there's a rising risk of higher inflation. Now, as you know, inflation has been ticking up. It's at 2.7% was the latest CPI, headline CPI. Is he right about the unemployment front specifically?
I don't think he is. I don't think the labor market is near as solid as he portrays it to be. He is singularly trying to shift our focus to the unemployment rate, to kind of shift our focus away from non-farm payrolls as the labor market conveniently contracts in size with immigration at a standstill and deportations taking on, meaning mathematically speaking, it's going to be harder to increase the unemployment rate. So I don't agree with his assessment of the labor market. Most Americans don't agree with his assessment of the labor market. And I think there's something to be said for tone deafness on the chair's part.
Just on the labor market, and we'll get back to the FOMC in just a minute. U.S. jobs openings fell to 7.4 million last month. Job market continues to cool. Employers posted 7.4 million job vacancies. The Labor Department reported Tuesday that job openings were down from 7.7 million. I mean, 300,000 jobs less for job openings. Is that a significant drawdown, or is this just normal?
I think it's normal in the current chapter of the economic cycle. We had we had a major quarterly revision to payrolls come out that shows that in the 12 months ended March of 2025, that payroll growth has on average been 32,000 a month. So yeah, I think in that framework, I think 300,000 is substantial.
So how would you characterize the overall health of the labor market right now?
I think it is. I think it's on very fragile footing. It's never a good thing when the front page of the Wall Street Journal has a story about CEOs flexing because they're firing people and replacing them with AI and offshoring to a greater extent. Obviously, it gives your stock price a nice pop, but that is kind of where we are. We are in cost-cutting mode. We saw that in the GDP data that came out. Non-residential fixed investment fell from a plus 10.3% rate in the first quarter to 1.9%. Every single recession in U.S. history has been led by declines in business investment. And we're certainly seeing that despite all of the enthusiasm and hope surrounding the big, beautiful bill unleashing expansion in the private sector, hiring in the private sector. We're not there. We're actually in a completely opposite mode right now.
I think part of the discussion around today's decision to not raise, or cut rates rather, was political. People wondering whether or not this is a politically motivated decision to keep rates unchanged. Actually, there were two dissenters, Bowman and Waller. Take a listen to this question, Q&A.
One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
The discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons they've.
All right. The two dissents came from runners-up to replace Powell. So what's going on here?
Well, yes, there is definitely politicking going on. There was an element of condescension in Powell's response. He's going to let them express why they did what they did. He emphasized that the majority was on board with him, and he just kind of brushed it off and moved on. It will be interesting to see, though, because they did soften the language in this statement about the strength of the U.S. economy, meaning it certainly wasn't a change in the verbiage of the statement to placate people he already knew was going to dissent, because the Wall Street Journal was called out last night to announce the dissents in advance of them happening, meaning there's a third dove. And if the preponderance of data continue to lean against the employment mandate being satisfied, I think we'll be hearing that from Fed speakers in the days and weeks to come, especially after non-farm payroll Fridays.
Do you have an idea, or have you thought about who might be the most likely candidate to replace him next year?
Well, is it going to be next year? I think is the more relevant question at this point, because, I've been saying this all day long, but the truth is, if this continues, if this public lynching continues, Jay Powell has every right to stay through the end of January 2028 and finish out his governor term if he chooses to do so, meaning Trump would only have this January's end of Adriana Kugler's term as a governor to install his replacement if he or she is going to come from the outside. And right now, that sounds like a foot race between the two Kevins, Kevin Warsh and Kevin Hassett. A lot can change between now and January, but I'm paying attention to who's going to replace Kugler. Because if Jay Powell legally decides to not leave in May of 2026, which he has every right to do and stay through January of 2028, then President Trump has to choose somebody already on the board to succeed him as chair.
Okay, let's go back to the FOMC meeting itself. So Powell said that both the labor market and inflation are at risk of deteriorating. And so my question is, if he thinks that the labor market is going to potentially weaken or show signs of softening, then that means he's not cutting rates now because he really believes inflation is going to run up. I mean, his language was more moderated than mine. He thinks it's somewhat elevated. Those are his words. But how bad is inflation going to get to spook the Fed to keep rates unchanged if they think the labor market is going to deteriorate?
Well, it's interesting you asked that question because today, the Cleveland Fed's new tenant rent index was published. It showed negative 9.8% over the quarter. Powell even mentioned once again market-based inflation measures, market-based PCE. And if you incorporate the Cleveland Fed new tenant rent index into the market-based core PCE, which he instructed us to do last December at the podium, then inflation year over year is running at negative 0.3%.
Which is significantly still higher than the Fed's 2% target. So what does this mean for policy?
Sorry, negative 0.3%.
Oh, negative. Oh, I'm sorry. I misheard you. Okay, negative. Wow. Okay, so policy error then?
Absolutely.
No? Policy
error. Look, there is services. Hilton International has told us, all four major U.S. air carriers have told us. Auto dealerships have told us. The new tenant rent index is telling us about apartment rents. We had Case-Shiller go. It's been negative for 3 months running for home prices. Shelter is the largest input to inflation. We have more disinflationary signals than you can shake a stick at that make up the vast majority of all inflation metrics, meaning that if there is a temporary blip in the inflation rate, it's going to indeed be temporary in nature, because what we have coming down the pipeline is disinflation, which is exactly what you have when you have companies in a cost-cutting mode firing people.
Yeah, okay, I'll play one more clip. This is a reporter asking Powell exactly what we just talked about. What would determine a rate cut then? Take a listen.
That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that, you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks that the housing market is in fact weak. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think is. Continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to.
Okay. Your reaction to what he just said?
He is trying to buy himself time. That's my reaction to what he just said. Again, Trueflation, TRU, something I've spoken about for many moons, real-time reflection of prices. It does show that some goods inflation is increasing and that is being compensated for by services disinflation. This morning, it was 2.04%, smack on the Fed's target. So again, I perceive the Fed chair, and the reason I think that the market turned tail and went red is because the market also perceives inflation to not be the problem, but rather the labor market. We've had 7 consecutive months of increasing reads on jobs are hard to get via the Conference Board. We've never had that without being in recession, ever.
Yeah, here's the Trueflation Index.
And it has
increased,
yes, but it is still contained because it's being depressed by services disinflation.
What is going to happen ultimately to the economy now that rates have been elevated for quite some time?
Well, we're going to have the private sector make a move. Japan and the EU have committed $1 trillion of investment. We're probably going to need to see them follow through with those commitments and start to put some money into the economy in order to spur business investment, which I just told you has collapsed. And we're going to need to see the firing stop and the hiring start. That's what has to happen. There have been a lot of promises made. There's a lot of enthusiasm out there for the future. That's great. But businesses are going to have to follow through with actions.
Is there any risk to the private sector for in terms of not being able to pay back debt or having their margins compressed by interest expenses that are still high because of where rates are currently?
I would certainly think so. It was off of a very low base, but Moody's reported an 80% increase in its default rate based on so many private equity companies going belly up. The bankruptcy cycle is still running full tilt ahead. We're obviously seeing a lot of stress in credit. And these things are going to manifest in cost cuts.
Okay, so here we go. This is the GDP data that came out. Economy grew at 3% in Q2, better than expected pace, even at Trump's tariffs hit. So what's happening right now is that the economy is growing faster than anticipated. And like you mentioned earlier, the trueflation is still low, and the actual disinflation that we see in the data is reflected in reality. And so the opposite of what tariffs are supposed to do is what's happening now. Can you explain that?
I can explain that because we have underemployment that is increasing. We have a gig economy that is clearly saturated. 40% of continuing jobless claimants have exhausted their benefits, meaning I collected unemployment benefits for 26 weeks, ran through them, still don't have a job. Continuing jobless claims are pushing 2 million. They're at the highest level since 2021. And there's ample evidence that white-collar job cuts and a lack of new job creation for college graduates has become highly problematic. So
then, with the economy growing at 3%, is it necessary still for the rest of the year to make any policy changes to the rates?
I think actually And here I'm going to switch hats for a second. Chair Powell did a very good job of trying to say we're going to look past the increases and the decreases in inventories and trade and just look at what businesses are investing and what consumers are consuming. And he said, if you look at the first half of 2025, we're south of 1%. That is not a sustainable rate.
Yeah, and here's the consumer confidence index that came out this week. Consumer confidence actually rose in the latest reading. So the Conference Board's gauge of confidence rose 2 points to 97.2. Data released on Tuesday. It climbed in July to 74.4. So the confidence is rising, although people are expressing concerns of finding jobs if they're out of the labor market, and if they're already in the labor market, there's been reports of people complaining about not getting raises. So why the dichotomy here?
Now you've thrown me a softball, David, and I'm disappointed because you never throw softballs. I'm just telling the truth. Inflation expectations have come down. And if you look inside the Conference Board report, the people survey respondents' expectations for the stock market to continue to rise have gone way up. So those things have they've made the wealthy people feel wealthier. It's pretty simple. People anticipate less inflation. People anticipate greater wealth, but they're expressing the highest level since March of 2021 in terms of, I'm worried I'm going to lose my job.
So how accurate is consumer confidence in predicting changes in the labor market? In other words, if they're not expressing concern about losing their job, I guess that's a self-fulfilling prophecy. Employers aren't signaling that they're going to cut jobs. Jobs
harder to get. The metric contained within the Conference Board has one of the tightest correlations with the unemployment rate in the history of the United States. Great question.
Okay. The ultimate outlook for the markets then. Rates are still elevated. Markets are pricing maybe one cut for the rest of the year. What does that mean for equities and fixed income?
As long as the Fed does not lower interest rates to the extent that you begin to scare the individuals who are collecting 4.25% on the $7.5 trillion in money market fund assets, who also happen to own 40% of the stock market, you're fine. If the Fed was to do something crazy like lower interest rates by 300 basis points, which the president called for today, then you would scare the savers out of their stock holdings. But as long as the flows hang in there, and as long as retail speculative mania stays intact, and as long as the baby boomers don't sell their stock, then you could just based purely on margin debt being at the highest on record, leveraged ETFs supporting the market, animal spirits being where they are, you could continue to see stocks near their all-time highs.
Forget what Powell and the Fed are looking at in terms of real-time indicators. Are there indicators that you look at, either coincident and or lagging indicators, that you really trust to show you where the real economy is headed?
I do. I looked at reports that came out this week that say that individuals who make more than $150,000 have the highest rate of increase in their delinquencies on their household debt. I find that to be relevant. I find it to be relevant that Fannie Mae took a $946 million charge off today based on expected losses in mortgages as the foreclosure cycle gets up and running. These are things that tell you what's going to happen tomorrow in the real economy. So do bankruptcies. So do rising household bankruptcies. So does the fact that as of August the 1st, which, I don't know, happens in 5 hot minutes, is when interest starts to accrue once again on millions of people who haven't paid their student loans in well over 5 years. Yeah.
I wonder if whether or not the data that you just cited is going to translate to asset prices, if the rich are defaulting on payments, or they're being delinquent on their home payments. Housing market crash, is that on the agenda?
I mean, crash is a big word. It's an overused word. So I'm not going to go there, but the evidence is there. The evidence is staring us in the face. The data is staring us in the face. The number of major metros with falling home prices has been moving like a blanket across the country, spreading like a plague. Okay. And that's what we know. And it's harder and harder to get financing. And we're seeing cancellation rates, according to Redfin, committed to buy homes, but then they're having to back away from them and cancel those. So lending standards are tightening right now. There's something that's undeniable about it. And that's one of the reasons that home builders are having to push through such massive, huge record levels of incentives to move product.
Even if rates come down a little bit, 25 basis points, 50 basis points, would that change the calculus?
I don't think 25 or 50 basis points is going to really move the needle. It will certainly help at the margin refinancing activity. But in terms of purchasing a house, I think what's more needed than anything else, now I'm going to speak directly out of the other side of my mouth, is the Fed holding policy pat where they are, because that's helping accelerate home price declines. Nobody wants to hear that. But that's just a fact of life. Housing is unaffordable, even if mortgage rates come down by 25 or 50 basis points. Housing remains very unaffordable. That's why first-time home buyers really are, at risk of extinction.
Is it far-fetched? Final question, I'll let you go. Is it far-fetched then to say that this actually long-term may not be a policy error because Powell is indirectly or perhaps directly helping first-time buyers enter the market, which is something that economists argue we need?
If you're speaking in ultimate terms and in eventualities, that is certainly the case. Let the housing market go. And by allowing a true correction in the housing market, and again, I think taking the Fed funds rate to the zero bound, I think that would hop up housing big time. Just restarting quantitative easing, another big booster for housing. But barring that, I think that a decent unwind in the housing market is going to allow an entire generation of home buyers to finally make their way in. To help matters, the biggest investors in the space are liquidating the homes that they own and selling them off to small investors.
Okay, we'll keep tabs on the housing market. We'll follow up next time. Thank you very much, Danielle. What are you following right now? What are you writing at QI Research? Give us an update.
And so actually, we just published a great full history that we put out free to the public on the history of Mariner Eccles, I cannot say his name, and the Eccles building. So people can go on my Substack and read that for free. If you're not already a subscriber to the Daily Feather, please become one. And if you're an institution, please come to qiresearch.com. Love to have you. Follow me on Twitter at DiMartino Booth.
Okay. Well, appreciate that. Thank you very much. We'll put the links down below so you can follow Danielle there. Speak again soon. Thank you for coming on Fed Day.
And thank you for having me.
And thank you for watching. Don't forget to like and subscribe.